Late last week, crude futures dropped as the president confirmed productive talks with Iran over an ongoing resolution to the Strait of Hormuz. But of course, at a new record pace just 3 hours later, there was a fresh wave of strikes on tankers, causing oil prices to bounce back up again and end the week higher. As a surprise to nobody, this also happened just 15 minutes after financial markets closed. A week before that, talks were set up in Doha. Prices fell. 6 days later, the talks were called a waste of time and prices rose. A week before that, prices were pushed down on positive announcements of great progress in negotiations and then rose again when that too fell apart. Prices rose, prices fell, rose again, fell again, rose again, fell again just after a conveniently timed trade, rose again, and this has all happened at least a dozen times. In the 3 days that it took to draft this analysis, the war has apparently been resolved and renewed another 2 times, which is a little bit embarrassing, not just geopolitically, but financially. These oil futures markets manage billions of dollars every day in one of the world's most vital resources and are run mostly by massive institutions with teams of highly skilled analysts at their disposal to piece together information ordinary people simply cannot access. Which raises an obvious question. How many times are these oil markets going to keep falling for this? If we are being generous, all of these announcements have clearly been premature. Realistically, it is clear that some level of market manipulation is occurring, with several instances of significant trades placed just minutes before major market movements. So, why are these supposedly highly informed, highly sophisticated market participants still following along with a pattern that basically everybody can see? And why are oil prices going ahead and falling anyway? The US and Israel launched a massive joint strike on Iran. Iranian officials stated the country closed the Strait of Hormuz. The US and Iran agreed to a temporary 2-week ceasefire. President Trump canceled the US delegation's trip to Pakistan and announced the US Navy would begin blocking Iranian oil shipments in the strait. Shortly after, during the G7 summit, the president discussed a signed memorandum agreement to end the conflict. Iran then disrupted traffic in the strait again with a drone attack on a container ship. When asked if the ceasefire was over, the president remarked that it was dead. U.S. Central Command confirmed strikes on dozens of targets aimed at degrading Iran's ability to attack international shipping. There are a few reasons why, despite clearly being meaningless at best or manipulation at worst, oil futures specifically are forced to play along with this geopolitical routine of announcements. The first is that these are real markets with real participants who have actual operations depending on the price of oil. Commodities futures markets are not built from the ground up purely for speculation. They serve a practical purpose. Oil futures markets like West Texas Intermediate and Brent allow real businesses to lock in prices for the future. This benefits oil producers and shippers by securing guaranteed pricing, while refiners can lock in a fixed quantity of raw inputs at a fixed rate. Unlike purely financial options, oil futures are physically settled. If you hold an oil future on the day of expiry, you must make physical arrangements for delivery. Holding a West Texas Intermediate futures contract at expiry means crude oil will be delivered to Cushing, Oklahoma, a major hub of storage tanks at the crossroads of key pipelines. For refineries, this is essential to feed their facilities. Normally, only about 2% to 3% of futures contracts ever end up physically delivered. Most participants close their positions or roll them forward before expiry. If someone agrees to sell a barrel of oil for $100 and the market shifts to $140, both parties usually settle the difference in cash rather than handling the physical barrel. But the possibility of delivery is what keeps the futures price tethered to reality. If a producer holds a physical barrel, the buyer must take it and cover the costs of properly storing a hazardous chemical. In April 2020, WTI futures briefly fell to negative $37 a barrel because reduced demand meant Cushing was running out of storage space. Traders literally paid others to take their contracts rather than accept physical delivery they had nowhere to store. Because these participants have physical operations depending on consistent supplies of crude, they are exposed to anything that disrupts their supply chain. For a refinery requiring crude deliveries, adjusting to announcements about the strait reopening or closing is necessary. Even if previous announcements turned out to be noise, these groups act as price takers. They accept market terms because their core business is producing, refining, shipping, or retailing fossil fuels, not speculating on price movements. They are also exposed to adjustments in strategic petroleum reserves and downstream panic buying. Normally, one might expect the future price of a barrel to stay close to current spot prices. But in April of this year, the gap between the physical market and the futures market grew to its widest level in decades, especially for Brent, which is physically delivered in North Sea terminals and heavily exposed to Middle Eastern and Asian markets. The difference between the futures price and the immediate spot price reached as high as $40 a barrel. Speculators predicting future prices assumed disruptions were overblown, while actual consumers had to pay whatever was asked for available physical crude. These markets are stuck in a difficult position. Firms needing crude oil as an input cannot risk running out of supplies, so they pay high prices. Meanwhile, speculators want to avoid the risk of oil flowing freely again, which would leave them holding physical delivery contracts no one wants to buy. It becomes a game where many participants simply choose to step aside. The real market participants forced to adapt to shifting war headlines make sense. But a second major issue is that speculators who normally cushion this market have largely pulled back. In standard conditions, two groups exist: actual suppliers and consumers, who forego speculative profits to lock in guaranteed prices and avoid risk, and speculators who accept price volatility, attempting to earn profits. The market operates as a risk transfer mechanism. Oil futures do not produce yield. They are contracts where profit relies on selling higher than the buy price. Despite being a zero-sum game, institutions spend millions conducting research to spot minor pricing discrepancies. Some firms launch imaging satellites to track production, count anchored tankers, and measure storage levels to gain an edge. Others focus on trading speed to react to news milliseconds faster. This high-speed trading contributes to immediate market reactions, often executing before humans process the news. However, that analytical edge evaporates with unpredictable geopolitical announcements. Proprietary research can be wiped out instantly by a last-minute statement. Because winning trades require a losing counterparty in a zero-sum market, many speculators are choosing not to trade. Speculators usually target high volatility, but recent swings are increasingly viewed as unacceptable risk. Data indicates net speculative open interest dropped toward a 16-year low. While hedge fund losses may draw little concern, these firms perform price discovery and provide liquidity between suppliers and users. In seeking profit, they absorb volatility that would otherwise hit oil companies directly. Without risk-accepting speculators, actual market participants absorb larger price swings directly. The market loses capacity to handle shocks, meaning even small announcements move prices further because fewer counterparties are willing to take the opposing side. A third factor is that this conflict is politically sensitive, with multiple administrations staking their reputation on controlling outcomes, heavily tied to price movements. Just as war announcements influence oil prices, price movements also influence political statements. Despite market vulnerability, trading is gradually beginning to ignore headlines. Historical tracking shows that while early statements about strikes caused 8% price surges, similar statements later yielded minimal movement or slight drops. Peace talk announcements that once caused massive price drops later resulted in minor 2% shifts. While physical actions like tanker strikes still move prices, verbal statements carry decreasing weight over time. Additionally, prices are returning toward pre-conflict levels due to shifting broader economic factors. Global oil consumption has dropped by an estimated 1 million barrels a day as high prices encourage efficiency. China, the largest crude importer, saw imports fall toward multi-year lows due to rapid electric vehicle adoption. Electric vehicles recently reached over 60% of new car sales in China, with domestic brands exceeding 80%. This transition displaced roughly 1 million barrels of oil demand per day in China alone, a figure growing annually. Major Chinese refiners estimate domestic gasoline demand peaked in 2023. Seeing this shift, producers are increasing supply to avoid losing market share. OPEC Plus raised production quotas, adding millions of barrels per day, with further increases approved. Forecasts now point toward a significant global crude surplus. Furthermore, market participants anticipate that crude stalled behind trade bottlenecks could eventually release all at once, creating temporary oversupply. Political pressure ahead of major elections has also led governments to utilize policy tools like sanction waivers to help keep domestic fuel prices stable. Together, these physical supply shifts, changing consumer demand, and reduced speculative activity explain why the market is increasingly looking past short-term headlines and driving prices lower.